What are the Oregon estate tax deductions? Have you ever wondered how to minimize the estate tax burden in Oregon? Understanding the deductions available can make a big difference in your estate planning. Let's break down what you need to know about Oregon estate tax deductions. Oregon imposes an estate tax on the estates of residents and some non-residents who own property in the state. This tax kicks in when the gross estate exceeds the exemption amount set by Oregon law. Deductions are essential because they reduce the taxable value of the estate, which can lower the amount owed to the state. One of the most significant deductions is the marital deduction. If assets pass to a surviving spouse who is a United States citizen, those assets are generally deductible from the taxable estate. This is similar to the federal marital deduction and is a common strategy for married couples. Another important deduction is the charitable deduction. Transfers made to qualified charitable organizations are deductible. This not only helps reduce the taxable estate but also encourages charitable giving as part of your estate planning. You can also deduct reasonable funeral expenses, administrative costs, and valid debts owed by the deceased at the time of death. This includes things like mortgages, medical bills, and other liabilities. It is essential to keep proper documentation for these expenses to ensure they are recognized as deductions. Certain losses incurred during estate administration, such as losses from theft or casualty, may also be deductible if they are not covered by insurance. For non-residents, Oregon only taxes the portion of the estate that includes assets located in the state. The state uses a fractional formula to determine what part of the estate is subject to Oregon tax. Even if property qualifies for a marital or charitable deduction, it only applies to the Oregon portion of the estate. This can lead to unexpected tax bills for non-residents with property in Oregon. Currently, the estate tax exemption in Oregon is $1 million. There are discussions about changing this in the future, including proposals to increase the exemption or adjust it for inflation. However, as it stands now, the $1 million exemption is in effect. For older adults and families, knowing about Oregon's estate tax deductions is vital for effective planning. Using marital and charitable deductions wisely can significantly reduce tax liability. It may also be beneficial to structure asset ownership to maximize deductions and minimize the taxable estate, especially for blended families or those with charitable intentions. Estate planners often recommend reviewing beneficiary designations, considering lifetime gifts, and exploring trusts that qualify for marital or charitable deductions. For clients with property in multiple states, it is crucial to pay attention to the rules regarding how deductions apply to non-resident estates. A common mistake is assuming that federal deductions automatically apply at the state level. While Oregon's deductions are similar, there are differences, especially for non-residents. Not accounting for administrative expenses or valid debts can also lead to higher tax bills than necessary. Understanding Oregon estate tax deductions is essential for minimizing state estate tax liability. By focusing on these deductions and staying informed about any legislative changes, you can make more informed decisions in your estate planning.